So today we're going to talk about how to build a tax-efficient portfolio. Assuming that you already have the optimal portfolio for your chosen risk level, the drag from taxes should be your next level of concern. Even long-term gain rates can be as high as 20%, not to mention the potential for an additional 3.8% from the net investment income tax, or sometimes you see it as NIIT. Whether it is long-term gains or regular income, you are susceptible to a higher percentage of your Social Security being taxed, as well as Medicare surcharges. For those with very high incomes, there are more sophisticated strategies that we're not going to go into here, but we can go after many of the straightforward strategies. Use account types to your advantage. The more tax-advantaged accounts include Roths and HSAs. It would make sense to put your assets with the greatest growth potential and tax efficiency in these accounts. IRAs, 401ks, and other tax-deferred vehicles are tax-advantaged accounts. It makes sense to put the assets with the next highest growth rate and tax inefficiency in these accounts. Taxable accounts, such as brokerage accounts, are the least tax-advantaged type of account. All capital gains and income generated in these accounts will flow into your tax filings. Be wary of tax inefficient and unpredictable assets in these accounts. Interest income, short-term gains, and surprise tax distributions from mutual funds have the ability to push you into higher income brackets and triggers. Now let's talk about the 2025 contribution limits. Since the passing of Secure Act 2.0 in 2022, many retirement account types have the Roth option. When deciding between a Roth versus a traditional account type, you need to guesstimate what your tax brackets will look like while you are contributing versus when you are distributing from your retirement accounts. Your goal is to pay the taxes when you are in the lower bracket. Once you have chosen what account type to contribute to for the time being, you need to look at account contribution limits. These limits can vary year to year and by account type. Based on your income and yearly savings amount, you can determine which accounts you are eligible for. When you get to the point of needing more ways to save money in a tax-efficient way, it is time to look at opening new account types and using strategies such as backdoor Roths, specific insurance policies, and giving or donating assets. In addition to income, you need to be aware of capital gains. Short-term gains are taxed like income at a higher rate. Long-term gains are taxed at the lower 0, 15, or 20% rates. Even with long-term gains, selling a significant asset can result in a significant tax bill. The good news is that there are ways to mitigate these taxes as well, such as through 1031 exchanges, opportunity zones, and grantor trusts. We have had the most success in investing in assets rather than trading assets. One of the pros of this strategy is that the majority of our gains are taxed at long-term gains when realized. This also gives you more control over what your realized gains may look like at the end of the year. One of the biggest conundrums of highly appreciated stock is when to reduce your position and pay the tax. While tax loss harvesting is a useful strategy, you may have gains that greatly surpass any losses. When this occurs, you have to balance your current and future tax liabilities along with your concentration risk. As a general rule, we don't like when an individual position exceeds 5% of your portfolio. Now, this does not mean 5% of an S&P 500 index, for example, because there are 500 plus individual positions in this position's wrapper. On a side note, you should know what is in any funds you own and have an idea of the allocation of the internal positions. If you cannot afford to take the risk of a single position being a large part of your portfolio, consider rebalancing. High returns generally come with high risk potential. Sometimes it makes sense to pay the tax instead of taking the outsized risk.